They've just made it impossible for you to succeed. Not publicly, not in writing, but in practice. $52,000. That's the cost they've attached to your capacity to trade silver. They increased it overnight. And if you don't grasp what just occurred, you're about to provide liquidity for the largest financial institutions on Wall Street. This isn't a practice run. This isn't hyperbole. This is economic combat, and you're in the crosshairs. At this moment, as I'm filming this content, silver sits at $115 on your display. That's the exchange price, the derivative price, the figure they prefer you observe. But here's what they're concealing from you. In Shanghai, tangible silver trades at $130 per ounce. In Tokyo, $140. In Dubai, $130. There's a $15 to $25 disparity between what actual silver costs globally and what the derivative market indicates. That's not a marketplace. That's an admission of guilt. Increasing margins on silver currently is like a gambling house altering regulations mid-game because you're profiting excessively. Except this manipulated system governs your future savings, and they've just overturned the board. The $52,000 margin increase, that's not protective management. That's an emergency brake engineered to shield the institutions, losing billions on the incorrect side of this position. Remain until this video concludes. I'm going to present you the precise documentation that demonstrates this is 1980 repeating itself, the identical strategy that bankrupted the Hunt brothers, and I'll reveal the single action you can execute that their $52,000 snare cannot affect. This intelligence could prevent you from becoming their next casualty. Welcome to the concealed financial system. If you wish to comprehend what Wall Street doesn't want revealed, like, subscribe, and activate notifications if you're prepared to discover reality. Let me begin with the documentation they published. The exchange just revealed new margin obligations for silver futures effective March 2026. The maintenance margin stands at $51.77 per contract. That's a 35% margin obligation. Let me provide that in context. A typical exchange silver futures contract represents 5,000 ounces of silver. To maintain that position, you currently need to deposit almost $52,000 in capital just to sustain the position, not to purchase the silver, merely to preserve your wager that silver rises. 3 weeks prior, that margin was $20,000. Then they elevated it to $25,000. Then $32,500. Now $52,000. In under a month, they've more than doubled the expense of holding long silver. Why would they execute that? The official explanation is volatility management, risk mitigation, safeguarding the clearinghouse. The actual explanation, the institutions are cornered and they're modifying the regulations to break free. And I possess evidence, recent evidence from 2 days earlier. Let me present you the exchange delivery report from January 26, 2026. This documentation just surfaced and it validates everything. January 2026 is currently the 6th largest silver delivery month in exchange history. Let me repeat that statement, the 6th largest on record. And here's the remarkable aspect. January isn't even a primary delivery month. Primary months are March, May, July, September, December. January is intended to be quiet. Nobody is expected to request delivery in January. But participants are demanding tangible silver immediately. 9,529 contracts delivered thus far with 4 trading days still left. Examine the historical information. March 2025 was the largest ever at 16,149 contracts. May 2025 came second at 15,122. September 2025 at 13,640. December 2025 at almost 13,000. January 2026 is already surpassing July 2025 in a minor month with days remaining. But here's what should genuinely capture your focus. Examine who is issuing delivery notices. J.P. Morgan Securities. 299 contracts issued in a single day. That's almost 1.5 million ounces of silver they're delivering in one day. Why would JP Morgan abruptly start delivering enormous amounts of tangible silver? Because they're covering their short positions. They're trapped and they recognize what's approaching in March. March is a primary delivery month. If January, a minor month, is already 6th largest in history, what do you anticipate March is going to resemble? The exchange is finished and the institutions recognize it. This is the same JP Morgan that paid $920 million in 2020 for manipulating precious metals, the largest penalty ever. They've been executing this strategy for decades. In 1980, the Hunt brothers accumulated silver. The exchange changed the regulations overnight, and the Hunts lost everything. Same strategy, different decade. But this time, something else is occurring that demonstrates the panic is genuine. Gold just reached an all-time high of $5,179 per ounce, and it occurred right after President Trump stated the dollar is performing excellently. The market heard that and immediately purchased gold. That reveals everything about what people genuinely believe about the dollar. When the president declares the dollar is strong and gold reaches record highs the same day, that's the market calling nonsense. That's intelligent money fleeing to tangible assets. Silver follows gold, always has, and silver is still undervalued compared to gold by historical measures. Now, let me present you what's occurring in tangible markets around the world, because this is where the genuine story exists. Let me present you the tangible silver prices globally right now. Shanghai, China, $130 per ounce. Tokyo, Japan, $140 per ounce. Dubai, UAE, $130 per ounce. Kuwait, $120 per ounce. Seoul, Korea, $118 per ounce. Exchange paper price, $115. Do you observe what's occurring? People who genuinely want tangible silver, actual metal they can possess in their hands, are compensating up to 25% more than the paper price. They're compensating premiums that have never existed before in contemporary markets. Why would anyone compensate $140 for silver in Tokyo when the display indicates $115? Because they don't trust the paper anymore, because they want actual metal, because they recognize the paper price is fraudulent. This is what participants call the Great Separation, the division of paper prices from tangible reality. And it's occurring right now. Someone expressed it perfectly. Silver at $140 in Tokyo and $115 on the exchange is not a market. It's an admission. Now, let me present you why this is about to become much worse. You already recognize about China's export limitations that commenced January 1st. 60 to 70% of global refined silver supply, now governed by 44 state-approved companies. Elon Musk called it not good. He's correct. But combine that with what is genuinely occurring at the exchange right now. In the first 2 weeks of January alone, 33.45 million ounces of silver were tangibly withdrawn from exchange vaults. That's 26% of registered inventory gone in days. Since 2020, exchange-registered inventory has dropped over 70%. From 346 million ounces to under 100 million, the vaults are emptying rapidly, and the January delivery information I just presented you demonstrates demand is accelerating. Now here's the figure that should keep you awake at night. According to analyst Faisalameen, the global paper-to-tangible ratio stands near 356 to 1. Let that register. For every 1 ounce of tangible silver that genuinely exists, there are 356 ounces of paper claims. Futures, options, ETFs, derivatives, 356 people who believe they possess an ounce of silver, but only one of them genuinely does. The other 355, they possess a commitment. A commitment from the same institutions who are now scrambling to deliver tangible metal before the whole system fractures. What occurs when people begin demanding delivery? What occurs when they comprehend the silver they assume they possess doesn't exist? This is called a short squeeze, and we're observing the arrangement occur in real time. Now let me inform you about the emergency brake, because this is how they intend to escape. Mike Maloney, one of the most respected precious metals analysts in the world, calls the margin increases a classic emergency brake. Here's how it operates. Step 1. Institutions accumulate enormous short positions over years. They sell silver they don't possess, wagering the price will decline. Step 2. Silver starts rising. Their losses accumulate. They need the price to drop so they can cover their shorts. Step 3, they elevate margin obligations. This forces smaller participants to liquidate their long positions. They cannot afford to maintain anymore. Step 4, the forced selling crashes the price. Step 5, institutions cover their shorts at lower prices. They escape their losses. Regular participants get eliminated. Step 6, price recovers. Institutions are safe. Regular people lost their capital. This isn't theory. This is documented. This is how they've functioned for decades. And the $52,000 margin, that's step 3 occurring right now. But here's what they didn't anticipate. The tangible market isn't cooperating anymore. See, this strategy functions when paper prices control reality, when everyone trusts the exchange price as the genuine price of silver. But what occurs when Shanghai is trading at 132 while the exchange indicates 115? What occurs when people in Dubai compensate $130 for an ounce of silver they can possess? The paper price becomes irrelevant. The tangible market takes control. And once that occurs, the institutions lose control entirely. We're observing the early stages of this right now, the great separation between paper and tangible, the two-tier market that analysts have been predicting for years. Let me provide you an analogy. Imagine you operate a gambling house. You've been selling chips that state they're worth $100 each, but you don't genuinely have enough capital in the vault to support them all. As long as everyone trusts the chips, no problem. Nobody requests capital. The game continues, but then people start cashing out. They want genuine capital, not chips, and you don't possess enough. What do you execute? You elevate the cost of participating. You make it harder to cash out. You modify the regulations to decelerate the redemptions. That's precisely what the $52,000 margin increase is. It's the house attempting to prevent a bank run. But here's the thing about bank runs. Once they commence, they accelerate. The more you attempt to halt them, the more people panic. Now, let me present you something even more concerning. Silver lease rates have exploded to 8%. Normally, these rates sit around 0.3 to 5%. 8% is insane. What is a lease rate? It's the expense to borrow silver. When institutions need tangible silver urgently, they compensate to borrow it from others who possess it. An 8% lease rate means someone is desperate enough to compensate 8% annually just to obtain their hands on silver. That only occurs when there's severe tangible shortage. The silver market is also in backwardation. That means the spot price is higher than the futures price. Normally, futures trade higher because of storage expenses and time value. When spot is higher than futures, it signals extreme immediate demand. People want silver now, not next month, not next quarter. Now, these are technical signals that scream shortage, and they're all flashing red right now. Let me take a breath here and inform you something amusing, because this gets intense, and we all need a moment. My Uber driver questioned me about exchange margins last week. I'm not joking. This guy picks me up and within 5 minutes he's questioning about silver futures maintenance obligations. I almost crashed my head into the seat in front of me. When Uber drivers are questioning about exchange margin increases, something has fundamentally changed in the world. Regular people are awakening. They're seeing through the strategy, and that terrifies the people operating the show. All right, back to business. Let me inform you about 3 types of people observing this content. The first type already possesses silver. You've been accumulating for years. You observe the price go sideways while everything else pumped, and now you're finally profitable. But you're frightened. You've observed them smash the price before. You've observed the manipulation. Part of you is waiting for them to take it all away again. The second type is curious. You've heard about silver. You've observed the headlines, but you don't possess any. You're attempting to determine if this is genuine or just another bubble. The third type is skeptical. You believe this sounds like conspiracy nonsense. You trust the system. You believe markets are fair. And I respect that skepticism. But I'm requesting you for 20 more minutes. Examine the information with me, just the information. Then formulate your own opinion. To the first type, I state this: don't let them shake you out. The manipulation is genuine, but so is the tangible shortage, and tangible beats paper every single time eventually. To the second type, I state this: execute your own research, verify everything I've stated, examine the exchange inventory information, examine the margin increases, examine the tangible premiums around the world, then formulate your own decision. To the third type, I state this: I was skeptical too until I observed the information, until I observed the patterns, until I observed what occurred to people just like you who believed they were safe. Believe this cannot occur to you? Believe American participants are somehow protected? Let me present you what occurred 3 weeks prior in India, because this is your warning. In Rajkot, one of the world's largest silver trading hubs, 44 trading firms declared bankruptcy in a single week. 44 companies, $425 million in losses, eliminated. Not over months, over hours. These were not amateurs. These were professional participants with decades of experience. They held silver positions, they were profitable, and then the exchange elevated margins, the price crashed, and they didn't possess enough capital to meet the margin calls. When the House moved the goalposts, they were eliminated in hours. That's not India's problem. That's a preview of what occurs when you participate the paper strategy against people who control the regulations. Now let me inform you what occurs next, because this situation cannot last forever. There are only 2 possible outcomes. Outcome 1, paper prices rise to meet tangible. The manipulation fails. Silver explodes higher. The institutions take enormous losses. Some may face serious financial stress, and everyone who held tangible silver makes generational wealth. Outcome 2, tangible markets abandon paper pricing entirely. The exchange becomes irrelevant. A 2-tier market emerges, one price for paper commitments, another price for actual metal. The world comprehends the paper market was a fiction all along. Either way, tangible silver succeeds. Either way, the people possessing actual metal are protected. The only question is timing. And based on the velocity of inventory drawdowns, the tangible premiums, the lease rates, and the desperate margin increases, I don't believe we have long to wait. Now here's something that might surprise you. I don't want the system to fail. I don't want institutions to collapse. I don't want chaos. What I want is honest price discovery. What I want is a market where the price on the display reflects reality. What I want is for regular people to have a fair opportunity. For decades, the silver market has been manipulated, the price has been suppressed, and regular people who trusted the system got hurt. The $52,000 margin increase is just the latest example. It's engineered to protect institutions at the expense of individuals. It's engineered to transfer wealth from regular participants to institutions who made bad wagers. That's not a free market. That's not capitalism. That's a manipulated strategy. And the only way to succeed a manipulated strategy is to stop participating by their regulations. Tangible silver doesn't have margin obligations. Tangible silver doesn't get liquidated when the exchange elevates the stakes. Tangible silver sits in your safe and doesn't care what the paper price indicates. This is why the tangible premiums are exploding around the world. This is why people in Tokyo compensate $140 for something the display indicates is worth $115. They've determined the strategy. They've stopped trusting the paper. They want actual metal. Now, let me provide you the information that makes this even more urgent. Silver has been in a supply deficit for 5 consecutive years. Every single year, the world consumes more silver than it mines. The cumulative deficit since 2019 is now over 1.3 billion ounces. Where did that silver originate from? Existing inventories. Stockpiles built up over decades, and those stockpiles are now running out. The Silver Institute projects the 2025 deficit will be the deepest on record. Nearly 300 million ounces. That's almost the entire annual production of Mexico, the world's largest silver producer. And unlike gold, silver gets consumed. It goes into solar panels, electric vehicles, smartphones, medical devices, and 1,000 other applications. It doesn't sit in a vault. It disappears into the global economy and never returns. Every solar panel needs about 20 grams of silver. Every electric vehicle needs 1 to 2 ounces. Every smartphone has silver in it. Every data center, every AI chip, every piece of contemporary technology. Silver isn't just a precious metal, it's an industrial necessity, and we're running out of easily accessible supply. This isn't fear-mongering, this is mathematics. Supply minus demand equals deficit. Deficit times years equals depleted inventory. Depleted inventory plus China export ban equals crisis. But I'll inform you what I'm personally executing. I'm not selling any tangible silver. I'm holding through the volatility on significant dips. I'm adding small amounts, capital I can afford to lose, capital that can sit for years if needed. I'm not trading futures. I'm not participating in the paper strategy. I'm holding metal, actual metal that doesn't have counterparty risk, actual metal that doesn't get liquidated when they elevate margins to $52,000. That's my strategy. Yours should fit your circumstances. Now let me provide you the other side because I wouldn't be honest if I didn't. Could silver crash from here? Yes. In 1980, after reaching $50, silver crashed 90%. It required over 40 years to recover. That occurred. It could occur again. Could the manipulation continue functioning? Yes. They have more tools, more tricks, more ways to modify the regulations. Never underestimate the desperation of institutions fighting for survival. Could I be completely incorrect? Yes, I've been incorrect before. I'll be incorrect again. Markets are unpredictable. Anyone who informs you otherwise is selling something. This is why you never invest capital you cannot afford to lose. This is why you diversify. This is why you formulate your own decisions based on your own research. But here's what I recognize for certain. The $52,000 margin increase is not normal. The 70% inventory drawdown is not normal. The $25 tangible premiums around the world are not normal. The 8% lease rates are not normal. The China export ban is not normal. Something is fracturing in the silver market. The old regulations are failing. And when systems fracture, wealth transfers from those who don't observe it approaching to those who do. The question is which side of that transfer you want to be on. Now, before I provide you my predictions, there's one more thing I need to present you. This is the part most people miss completely, and it could be the difference between getting trapped and building wealth. Let me explain why this $52,000 margin is mathematically engineered to eliminate you from the strategy. A standard exchange silver contract is 5,000 ounces. At $115 per ounce, that contract controls $575,000 worth of silver. With a $52,000 margin obligation, you need almost 10% of the total value in capital just to maintain the position. That's insane leverage restriction. Compare this to stocks. Most brokers let you trade stocks with 50% margin. Some futures contracts have 2 to 3% margins, but silver they want 10%, and they elevated it there in less than a month. Why? Because at lower margins, regular people can participate. They can maintain positions. They can ride the bull market higher. At $52,000, regular people are priced out. Only institutions and wealthy individuals can participate. This is financial gatekeeping disguised as risk management. And here's the genuinely clever part. They're not just elevating the dollar amount, they modify the entire system. As of January 13th, the exchange moved to percentage-based margins instead of fixed dollar amounts. Silver is now at 9% of contract value. What does that mean? Every time silver goes up, the margin obligation goes up automatically. You need more capital just to maintain the same position. In a bull market, this is brutal for long positions. The higher silver goes, the more capital you need. Many participants cannot keep up. They get liquidated, and their forced selling pushes prices back down. This is the definition of a manipulated strategy. The regulations automatically function against anyone wagering on higher prices. But here's what they didn't consider. Tangible silver doesn't participate by these regulations. When you possess tangible silver, you don't have margin obligations. You don't get liquidation notices. You don't need to deposit more capital as prices rise. You just possess metal, actual metal in your possession. This is why the intelligent capital around the world is abandoning paper and going tangible. This is why premiums in Shanghai and Tokyo and Dubai are exploding. They've determined that the paper market is manipulated against them, so they're exiting the paper market entirely. Now, let me present you something fascinating about what's occurring in the futures market right now. Normally, when participants hold futures contracts, they roll forward. They close their current contract and open a new one further in the future. They maintain exposure without taking delivery. This is how the paper strategy functions. Nobody genuinely wants the silver. They just want the price exposure. But something strange is occurring. Participants are rolling backward. They're moving from March contracts to January and February contracts. They're accelerating their delivery timelines. Why would anyone execute that? Because they want the metal now, not later. Now, they don't trust that the metal will be there in March. They want to lock in delivery as soon as possible. This is an enormous red flag for the exchange. If everyone starts demanding delivery at once, the exchange fractures. They don't possess enough silver to fulfill all the contracts. Remember that 356-to-1 ratio, 356 paper ounces for every one tangible ounce. If even a small percentage of those paper holders demand delivery, the exchange cannot deliver. They have to settle in capital. And when that occurs, everyone comprehends the paper price is fiction. That's called force majeure. It's when an exchange admits it cannot fulfill its obligations. And it has occurred before in other commodity markets. We're observing the conditions for this develop in real time. Now let me provide you my timeline because I recognize you want specifics, and I'm not going to hedge. This is what I believe is approaching. Not hope, not speculation. This is where the information points. January and February. Extreme volatility. More margin increases possible. Frightening headlines. Mainstream media calling it a bubble. This is the shakeout phase. Weak hands exit. Strong hands accumulate. If you panic, sell here. You're executing precisely what they want. March through May. Supply constraints become undeniable. Tangible premiums persist or expand. Silver tests 120 to 130 on the exchange. Mining stocks start to move. This is when mainstream media starts changing their tune. June through September. If tangible keeps draining at current rates, we could observe delivery stress at the exchange. Potential for capital settlement events. Price discovery starts shifting to tangible markets. This is when the great separation becomes permanent. End of year. My target is $175 to $200 silver, possibly higher if there's a dollar crisis or major geopolitical event. And based on what I'm observing, I believe that target might be conservative. Could I be incorrect? Always possible. Markets surprise everyone eventually, but the arrangement has never been this clear. The information has never been this compelling, and the desperation has never been this obvious. Let me leave you with one final thought. Throughout history, every paper currency system has eventually failed. Every attempt to suppress the price of gold and silver has eventually collapsed. Every manipulation scheme has an expiration date. The question is never if. The question is when. I believe we're approaching that when. The divergence between paper and tangible is too large. The inventory drawdowns are too rapid. The desperation moves are too obvious. The $52,000 margin is not strength. It's panic. It's an institution fighting for survival. It's the last move of a player who recognizes they're losing. And when that player finally loses, the wealth transfer will be historic. From paper to tangible, from Wall Street to Main Street, from those who manipulated to those who accumulated. Make sure you're on the correct side of that transfer. Screenshot this content. Save it. Return in 6 months. Return in a year. Let's observe together how this plays out. 5 years from now, January 2026 will be remembered. The month silver crossed $115. The month they elevated margins to 52,000. The month the great separation between paper and tangible became undeniable. And you'll either be grateful you observed it approaching, or you'll wish you had. The snare has been set. $52,000, that's the cost of participating their strategy. But here's the secret. You don't have to participate their strategy. You can possess tangible. You can step outside this manipulated system entirely. You can possess actual metal that no margin increase can take away. That's not financial advice. That's just observation. What you execute with it is up to you. Drop your thoughts in the comments if this opened your eyes. Send this to one person who needs to observe it. One person who has no idea what's occurring right now. Remember those figures. 140 in Tokyo, 132 in Shanghai, 130 in Dubai, and 115 on your display. That gap is the truth they cannot conceal anymore. Subscribe for more truth because the genuine story is never on the surface. I'll observe you in the next one. Stay awake, stay tangible, and whatever you execute, don't let them shake you out.